Hello everyone, and welcome back to the channel. Today, we're diving into one of the most explosive stories in the financial world right now, the monumental surge in the price of silver. What we're witnessing isn't just a minor fluctuation, it's a historic event, and we're going to break down exactly what's happening, why it's happening, and what it could mean for you as an investor. Let's start with the big news out of London, the heart of the global precious metals market. The London Bullion Market Association, or LBMA, is reporting unprecedented activity. Silver spot prices have not just climbed, they've launched into record territory, smashing previous highs and leaving market analysts scrambling to keep up. We're talking about a price leap that has reset the entire conversation around precious metals. But this isn't just a story about numbers on a screen. The real drama is happening on the ground. The LBMA, which oversees the largest physical silver market in the world, is facing a severe supply squeeze. Reports are flooding in about a significant shortage of physical silver bars. For context, the LBMA vaults are supposed to be the ultimate backstop for the global silver trade. When those vaults start running low, it sends a powerful signal to the entire market. The demand for real, tangible silver is outstripping the available supply. This isn't a paper market phenomenon. This is a physical shortage at the very core of the system. So who's buying all this silver? While institutional demand is a huge part of the story, what's really turning heads is the massive surge in retail buying. Everyday investors, from seasoned silver stackers to brand new buyers, are flocking to dealers and online platforms to get their hands on physical silver. We're seeing premiums on coins and small bars skyrocket as dealers struggle to replenish their inventories. This isn't just a trend, it's a movement. People are waking up to the intrinsic value of silver. They want to own the real thing, not just a paper contract. This grassroots demand is adding incredible pressure to an already strained supply chain. Now, to truly understand why this is happening, we need to look beyond the immediate buying frenzy and examine the bigger picture, the structural deficit in the silver market. For years, experts have been pointing to a growing gap between silver supply and demand. And what's driving this demand? It's not just investment. Silver is a critical industrial metal. Think about the global push towards green energy. Solar panels are a massive consumer of silver. Every single photovoltaic cell contains silver paste, and as the world transitions to renewable energy, the demand for solar panels is exploding. The International Energy Agency projects solar to become the primary source of global electricity, and every panel that goes up needs silver. This isn't a future projection. This is happening right now, and it's consuming millions of ounces of silver annually. Then there's the electronics industry. Your smartphone, your laptop, your car's infotainment system, they all contain silver. It's one of the best electrical and thermal conductors known to man, making it indispensable in modern technology. And as we move into the era of 5G, the Internet of Things, and electric vehicles, the industrial demand for silver is set to grow exponentially. An electric vehicle, for example, can use nearly twice as much silver as a traditional internal combustion engine car. So we have this perfect storm, a structural deficit caused by soaring industrial demand colliding with a massive wave of investment demand. For years, the silver price was often seen as being suppressed or manipulated, failing to reflect these strong fundamentals. What we might be seeing now is the breaking point, the moment when the physical reality of supply and demand finally overwhelms the paper markets that have dictated the price for so long. Let's bring this home for U.S. investors. What does this all mean for you? For a long time, silver has been called poor man's gold, always living in the shadow of its yellow counterpart. It often traded in lockstep with gold, following its lead. But what the recent price action suggests is that silver is starting to break free. It's beginning to trade on its own powerful fundamentals. The industrial demand component gives silver a unique dual identity that gold doesn't have. It's both a monetary metal and a critical commodity. This means that investors are starting to look at silver not just as a hedge against inflation or safe haven asset, but as a growth asset tied to the technological and green revolutions that are reshaping our world. The narrative is shifting from silver as a defensive play to silver as an offensive one. However, it's crucial to address the volatility. With this kind of explosive price movement comes significant risk. The silver market is notoriously volatile. Sharper run-ups can be followed by sharp corrections. Anyone considering investing in silver needs to understand this. This is not a get-rich-quick scheme. It's a long-term story about fundamental supply and demand imbalances. If you are investing, be prepared for a wild ride. The forces at play are immense, and the battle between the physical market and the paper market could lead to some dramatic price swings in the short term. So, what should you watch for next? Keep a close eye on the inventory levels at major exchanges like the LBMA and COMEX. Any further depletion of registered stockpiles will be a major bullish signal. Watch the premiums on physical products. They are a real-time indicator of retail demand and supply tightness. And of course, pay attention to the industrial consumption reports from sectors like solar and electronics. In conclusion, the silver market is at a historic crossroads. The recent price surge in London is more than just a headline. It's a symptom of a deep structural shift that has been building for years. A physical supply shortage driven by relentless industrial demand, and now amplified by a retail buying frenzy, is challenging the long-standing pricing mechanisms. Silver is stepping out of gold's shadow and asserting its own unique value proposition as a critical metal for the future. For investors, this presents both a tremendous opportunity and a significant risk. The story is just beginning to unfold, and it's one of the most exciting narratives in finance today. Do your own research, understand the risks, and decide if this powerful trend has a place in your portfolio. Thanks so much for tuning in today. If you found this analysis helpful, please hit that like button, subscribe to the channel, and ring the notification bell so you don't miss our future updates on this developing story. We'd love to hear your thoughts in the comments below. What do you think is next for silver? Let's discuss. Thanks for watching, and we'll see you in the next video. Silver's rally continues to dominate global markets, not as a short-term blip, but as a structural shift in how one of the world's oldest commodities is valued and traded. As the London Bullion market opened recently, the price action reinforced a message investors can no longer ignore. Silver amassed real economic value can be hidden behind volatility or market noise. The second part of our deep dive unpacks the latest price trends, physical market pressures from the London Bullion Market Association, LBMA, structural supply-demand deficits, implications for U.S. traders, and what analysts are forecasting through 2026. As of mid-February 2026, silver traded near 82.85 per troy ounce, up about 157% compared with the same time last year. The metal swung between a high of 121.58 in late January and recent price levels near $80.85, reflecting both record-breaking rallies and sharp corrections. This behavior is not random. It's symptomatic of a market caught between explosive investment demand and tight physical supply, especially in the London spot market, where prices are set for much of the world's metal. In January 2026, silver crossed the historic 98-ounce threshold, marking one of its most significant rallies in decades and signaling what some analysts describe as a fundamental realignment of the precious metals complex. London remains central to this narrative. Despite occasional increases in vault inventories, such as a modest 3.5% rise in November, the LBMA free float, the physical metal available for immediate delivery, remains unusually tight. The implications are clear. Backwardation signals real scarcity. Spot prices higher than futures often indicate strong physical demand relative to delivery supply. Lease rates and premiums remain elevated, squeezing both refiners and traders. Physical scarcity pressures paper markets, where futures contracts alone aren't backed by deliverable metal. All of these factors reinforce the idea that the silver price isn't being driven only by speculation. Real supply constraints matter. One of the most compelling drivers of today's silver price action is the ongoing structural supply deficit. According to industry data, the global silver market is expected to experience its sixth straight annual deficit in 2026, where total demand outpaces all sources of supply, including mine output and recycling. That means for 6 years in a row, the world has consumed more silver than it produced, forcing the market to draw down existing inventories or tap above-ground stocks. Sustained deficits of this magnitude are rare in commodity markets and suggest that tightness in deliverable supply is a persistent structural theme, not a temporary anomaly. Silver demand today is moving across multiple fronts, and understanding these is key to why prices have moved so dramatically. Retail investors and institutions continue to put money into silver-backed ETFs, with physical holdings driving tight supplies. Even as prices pull back from record highs, many investors treat dips as buying opportunities, reinforcing upward pressure. Silver remains a critical industrial metal used in solar photovoltaic cells, electronics and semiconductors, electric vehicle components, and medical and industrial applications. Even with higher prices dampening some industrial demand, long-term growth in these sectors supports elevated price floors. Silver benefits from both traditional safe haven demand, like gold, and speculative flows driven by geopolitical stress and economic uncertainty. Analysts note that safe haven rallies in gold often spill over into silver, adding momentum in precious metals markets. While 2025-2026 has been bullish, Price swings have been dramatic. Some industry forecasts paint mixed scenarios. HSBC expects strong first-half momentum due to tight markets and macro support, but warns that volatility will persist into 2026 and beyond. Short-term pullbacks are possible as supply improves or demand normalizes, but structural deficits and persistent investment interest act as counterweights. This environment, high upside potential but significant risk, is why silver is frequently described as a volatile but potentially high-return asset. For investors in the United States, from Wall Street fund managers to everyday traders, here are the most important insights from London, Open, and the broader silver market. Historically overshadowed by gold, silver and its recent behavior suggests it's stepping into a standalone role as both a commodity and a financial asset. Price swings that once seemed extreme are now normal for silver. Strategic traders can benefit, but risk management is essential. Backwardation and physical premiums aren't academic concepts. They are real drivers that reflect supply strains, not just paper price movement. Despite periodic sell-offs or profit-taking, the underlying supply deficit and industrial demand backdrop suggest that silver Inc.'s price floor may be higher than many long-term investors previously assumed. The silver market isn't isolated. It's highly sensitive to macroeconomic forces like U.S. Federal Reserve policy, dollar strength or weakness, geopolitical tensions, and trade tariff policies that affect global metal flows. Sharp price moves in recent weeks, including large spikes and deep corrections, correlate with macroeconomic news and changing investor sentiment. Predicting precise prices is impossible, but current trends and forecasts suggest several potential outcomes. Continued supply deficits, strong retail and institutional investment flows, safe haven demand in the face of global uncertainty, and new industrial applications, increasing long-term demand could push prices above recent historic highs, especially if physical tightness persists or intensifies. However, supply response? Demand normalization from volatility or industrial contraction or macro shifts. Hey everyone, and welcome back to the channel. Today we're diving deep into a topic that's been generating a lot of buzz, the silver market. Specifically, we're going to look ahead to 2026 and explore what could be a seismic shift in how this precious metal is valued and traded. We'll be breaking down the market's reality, the structural supply deficit, the strain on major exchanges, and what it all means for you as an investor. This isn't just about numbers, it's about understanding the fundamental story of silver unfolding right now. So grab a coffee, get comfortable, and let's get into it. First, let's set the stage. For years, the silver narrative has been complex. It's often lived in the shadow of gold, but its unique dual role as both a monetary metal and an indispensable industrial component makes its story far more intricate. When we talk about the 2026 market reality, we're not just pulling a year out of thin air. We're looking at the culmination of several powerful trends that have been building for a long time. The key takeaway is this: the paper market, which has long influenced silver's price, is beginning to show cracks under the immense pressure of physical demand. This isn't a prediction of a specific price on a specific day, but an analysis of a structural change that could redefine the entire silver landscape. At the heart of this change is the structural supply deficit. For years, the world has been consuming more silver than it mines. Think about that for a second. We are consistently using more of this critical resource than we can pull out of the ground. For a while, this deficit was balanced by above-ground stockpiles, old silver reserves that could be drawn down to meet demand. But those stockpiles are not infinite. According to reports from major analysts and institutions like the Silver Institute, we've seen a significant deficit in recent years, and this trend is projected to continue. Mine production has struggled to keep pace. Opening a new silver mine is an incredibly slow and expensive process, often taking a decade or more from discovery to production. So we can't just flip a switch and get more silver. This persistent imbalance between what we produce and what we consume is the foundational crack in the old market structure. This brings us to the exchanges, specifically the London Bullion Market Association, or LBMA, and the COMEX in New York. These are the epicenters of the global silver trade. The LBMA is the world's largest wholesale over-the-counter market for physical silver. For a long time, it operated smoothly. But recently, we've seen reports of significant physical strain. The visible silver stocks in London vaults have been steadily declining. This means that the buffer of physical metal available to back the massive volume of paper trading is shrinking. When large players decide they want to take physical delivery of their silver instead of just trading paper contracts, it puts immense pressure on the system. It's like a bank run, but for silver. If enough contract holders demand the real metal and the vaults can't deliver, confidence in the entire paper market system could be shaken to its core. Similarly, let's look at the COMEX. This is primarily a futures market where contracts for future delivery of silver are traded. Historically, only a tiny fraction of these contracts ever stand for physical delivery. Most are settled in cash. However, we're seeing a notable trend where the number of contracts demanding physical delivery is increasing. This forces the COMEX to source and deliver actual 1,000-ounce silver bars from its approved vaults. Just like the LBMA, as these vaults are drained, the pressure mounts. If the exchange struggles to meet its delivery obligations, it signals a major disconnect between the paper price and the true value of physical silver. By 2026, the cumulative effect of these delivery pressures could force a major reckoning, potentially leading to a situation where the paper price has to rapidly adjust upwards to reflect the scarcity of the physical metal. Now, let's talk about the demand side of the equation, because it's absolutely explosive. The industrial demand for silver is non-negotiable and growing at a staggering pace. Silver is not just a pretty metal for jewelry or coins, it is a technological marvel. It has the highest electrical and thermal conductivity of any element, making it irreplaceable in a vast array of modern technologies. The two biggest drivers are solar energy and electric vehicles. Every solar panel contains silver. As the world pushes for a green energy transition, the demand for solar panels is skyrocketing, and with it, the demand for silver. Similarly, electric vehicles use significantly more silver than traditional internal combustion engine cars in everything from battery connections to heated windshields. Add to this the ever-growing demand from 5G technology, electronics, and medical applications, and you have a perfect storm of industrial consumption. This demand is largely inelastic, meaning industries will pay whatever it takes to get the silver they need, because there are no viable substitutes. Alongside this industrial behemoth, we have the behavior of retail investors and exchange-traded funds, or ETFs. The retail side, often called the silver stackers, has become a powerful force. Movements like the silver squeeze demonstrated the collective power of individual investors, buying up physical coins and bars. This directly removes metal from the wholesale market, adding another layer of strain on supply. When people buy a 1-ounce silver eagle or a 10-ounce bar, that silver is essentially taken out of the industrial supply chain for good. Meanwhile, silver ETFs, like SLV, are supposed to be backed by physical silver stored in vaults. When investors pour money into these ETFs, the fund managers must go into the market and buy huge 1,000-ounce bars to back the shares. This acts as another massive source of demand, competing directly with industrial users for the same limited pool of available metal. The interplay between strong, steady retail buying and large, sporadic ETF inflows creates a volatile but consistently upward pressure on physical demand. Of course, we can't discuss any market without considering the macro forces at play. We are living in an era of unprecedented monetary policy. Governments and central banks around the world have engaged in massive currency creation and deficit spending. This devalues fiat currencies and pushes investors to seek safe haven assets that can preserve their wealth. Silver, like gold,